The primary aim was to avoid financial losses. Even though the Federal Reserve has slowed the rate of interest increases, monthly mortgage costs are still twice what they were just a year and a half ago. This has decreased the availability of properties on sale as homeowners who locked in low rates during the pandemic are reluctant to sell and risk paying significantly higher borrowing costs on a new mortgage. Due to the limited availability of properties, home prices have remained stable and are even increasing despite a substantial rise in borrowing costs. Real estate agents and economists suggest that any mortgage rate below 3% is a valuable asset that homeowners are hesitant to let go of. However, every asset has a price tag. Now, a rising group of investors and real estate agents are attempting to sell past mortgage rates to new buyers by transferring them. Redfin, the real estate brokerage, has witnessed a significant increase in listings like Mr. Kilboy's that mention features such as gorgeous home with assumable loan at 3.25%. Dedicated Facebook groups have emerged to find buyers, and new companies are offering services to facilitate the transfer process. Homeowners with assumable mortgages hold a valuable asset that many home buyers desire and would pay for, explained Daryl Fairweather, chief economist at Redfin. For those who bought when home prices were at their peak, but mortgage rates were low, it could be an attractive strategy to offset a regretful purchase. Investors are also eager to get involved. The subtle term creative finance is increasingly discussed on platforms like BiggerPockets, a forum where landlords share advice on subjects such as managing short-term rentals or purchasing a first investment property. Influencers are offering advice through books, seminars, and YouTube videos on how to find homeowners willing to transfer their low-rate mortgages, a valuable but very risky strategy. Scott Trench, CEO of BiggerPockets, warned that such strategies often involve additional risks and paperwork that most people are unfamiliar with, even though the concept is tempting. The variety of methods highlight how the nation's real estate market is paralyzed by regret. Buyers are frustrated that the low-cost mortgages are no longer available. Sellers are unwilling to decrease their prices from the pandemic peaks. Instead of acceptance, a select few are using creativity and fine print to recreate the affordable lending conditions of 2021. While most U.S. mortgages are not directly assumable, a large number of popular government-backed mortgages are, according to Michael Fratantoni, chief economist at the Mortgage Bankers Association. These loans are frequently chosen by first-time buyers and account for about a quarter of outstanding mortgages. In theory, any homeowner with an assumable low-rate mortgage has a valuable bonus to sell along with their property. However, real estate agents admit that transferring these can be difficult in practice. In the light of this trend, Craig O'Boyle aims to establish a business that facilitates faster and easier mortgage assumptions. Last year, he and a partner founded Assumption Solutions, a consulting firm that assists real estate agents in transferring mortgages between sellers and buyers for $1,100 per deal processing fee. Mr. O'Boyle suggests that they advertise sub-3% rates just like luxurious amenities or attractive views. Furthermore, to encourage new loans, mortgage companies have begun offering products where borrowers can buy down rates by paying a few $1,000s for a temporary reduction in interest. One popular product is a 2-1 buy-down, where a borrower pays for a reduction of 2 percentage points in the first year and 1 in the second. Usually, it's a lump sum at closing that buyers use to temporarily lower rates. Sellers with a lot of equity can act as lenders and finance the buyer's purchase below the prevailing rates, a practice known as seller financing. Assuming mortgages and paying down rates are innovative yet straightforward solutions to increasing borrowing costs. However, some investors looking to buy homes with minimal cash are trying a riskier method known as subject to or subto, where they take over the low interest payments of people who have fallen behind on their debts. While this strategy can be appealing when interest rates are high, it comes with a significant caveat. Once a property has been sold, banks usually have the right to call the loan, demanding immediate full payment of the outstanding mortgage. If the buyer fails to keep up with payments, the property can still be foreclosed, damaging the seller's credit, even though they no longer own the home.